There's something unsettling about the way Michael Burry is moving his money right now. While most investors are celebrating one of the strongest US stock market rallies in history, he's heading for the exits. The man who predicted and profited from the 2008 crash is once again selling, this time unloading over $70 million in US stocks. He's not just trimming his portfolio, he's making an aggressive exit from some of the biggest names in the market. The question is, why? The man who saw it coming again and again. Michael Burry has built his reputation on seeing what others miss. Back in the early 2000s, when Wall Street was blinded by the housing bubble, he was quietly running the numbers, convinced that the mortgage market was a ticking time bomb. The world laughed at him until the collapse happened. His bet against the housing market made his investors over $700 million, while he personally walked away with $100 million. Since then, he's made several bold calls, from predicting inflationary spikes to warning about overvalued assets. He isn't always right in the short term, but history has shown that ignoring Burry can be a costly mistake. Now, in 2025, he's ringing the alarm bells once again. In recent months, Burry has completely sold out of 14 different US stocks, a move that amounts to over $70 million in liquidations. Earlier this year, he also exited his positions in Amazon and Alphabet, two of the best-performing stocks in 2024. On the surface, this might seem like a strange decision. Tech stocks have soared this year, and the broader market is riding high on optimism. But for Burry, this isn't about chasing short-term gains, it's about avoiding long-term disaster. The two major red flags in the US market. There are two key reasons why Burry is stepping away from US stocks: valuation and concentration. Valuation is a serious concern right now. A useful way to measure whether stocks are overpriced is by looking at the price-to-earnings ratio. The S&P 500's PE ratio has reached levels that we've only seen twice before in history, once in the late 1990s, just before the dot-com bubble burst, and again in 2021, when pandemic stimulus inflated stock prices. Both times, markets eventually collapsed. The second problem is market concentration. Right now, just 4 companies, Amazon, Microsoft, Nvidia, and Apple, make up a staggering 25% of the entire S&P 500. This level of dominance is unprecedented, even worse than the late 1990s, when companies like Cisco, General Electric, Intel, and IBM held a similar stranglehold on the market. The issue with high concentration is that it makes the entire market fragile. For Burry, this setup is eerily similar to past market crashes. He's not interested in waiting to see how long the rally can last. He's exiting before the inevitable downturn. The surprising new bet: China. While Burry is pulling his money out of the US, he's making a major shift toward China. In the third quarter of 2024, he increased his position in 3 major Chinese tech companies: Alibaba, JD.com, and Bilibili. His stake in Alibaba grew by 29% to $21 million. JD.com saw an even bigger jump, with his holdings doubling to $20 million. He also made a bold move with Bilibili, increasing his position by 67% to $13 million. Altogether, these investments account for $55 million, a major portion of his portfolio. Why is Burry betting on China? Chinese stocks are currently among the cheapest in the world. While US stocks are trading at historically high valuations, China's market is sitting at one of its lowest points in decades. The price-to-earnings ratio of China's stock market is just 10.2, a number that hasn't been this low since 1996. Even with these rock-bottom prices, global investors remain deeply pessimistic about China, which has kept stock valuations suppressed. This makes China the complete opposite of the US market right now. Low risk in terms of valuation, but with high potential rewards if the economy turns around. Can China rebound? For the past few years, China has struggled with economic challenges, including a weak real estate sector and declining consumer confidence. The stock market has fallen more than 60% since 2021, reflecting this pessimism. However, in 2024, the Chinese government has started taking aggressive steps to reverse the downturn. In January 2024, China's central bank injected $140 billion into the economy by cutting the reserve requirement ratio. This led to a brief rally in the stock market, but the gains didn't hold. In September, another round of stimulus was announced, including interest rate cuts, mortgage rate reductions, and an equity market support package worth $110 billion. This time, stocks surged by 50% almost instantly. Then, in October, China unveiled its largest stimulus package yet, a $1.4 trillion plan spread over 5 years. Some analysts have called it the bazooka stimulus, a sign that the government is willing to go all in to revive economic growth. These measures are already starting to show an impact. Disposable income in China, which had been stagnant for years, is now projected to grow by 50% over the next 5 years. If that happens, consumer spending could surge, fueling growth for major tech companies. Burry appears to be betting that this turnaround is inevitable. A safety net, how Burry is hedging his bet. Even though Burry sees long-term potential in China, he's not taking unnecessary risks. Instead, he's protecting himself by purchasing put options, a form of insurance that allows him to profit if Chinese stocks decline. He has put options covering $18 million worth of Alibaba shares, an entire hedge on JD.com, and nearly $9 million in Bilibili. In total, these hedges cover 80% of his China trade, ensuring that even if the market drops further, he won't take a massive hit. The Trump factor, a risk for China. There's another possible reason why Burry is hedging so aggressively: US-China tensions. Trump has historically been hostile toward China, implementing tariffs and restrictions that have hurt Chinese businesses. As he resumes his presidency, there's a risk that tensions could escalate again, negatively impacting Chinese stocks in the short term. Burry's put options suggest that he is aware of this risk and is preparing for volatility ahead. The question now is whether he's right. What do you think? Let's talk in the comments. And if you found this analysis valuable, hit the like button, subscribe for more insights, and turn on notifications so you don't miss the next big market shift. See you in the next one.